Welcome back, another episode of the Property Coaching Network podcast. This is episode 24, and today I've got my broker, Emma Ross, with me.
Hi.
Who's hungover from Saturday.
Actually, I'm trying to not be hungover. Like, see, on the way here, I was like trying to put my music up full blast, like trying to
get in the zone
I
for
was
it.
like, right, Emma, you need to not be hungover.
It's Tuesday, man. How can you
I
still be hungover?
know, it's not my fault.
Who is it then?
I don't want to name names, but people keep me out late.
Right. What time did you get in on Saturday?
5 in the morning.
Was it? Oh, for fuck's sake. Right, okay. Move on then.
Change the subject.
So most people probably do know you that watch and listen to my podcast, Emma, but just tell them a little bit about yourself and what you do now.
So it's called a commercial broker, but I feel
Sorry, I jump in right already, but this is what annoys you, because people think, but it's commercial property, innit? Do you get that a lot?
All the time. So there was that element of me that thought when I was setting up, do I call it Ross Commercial Finance?
Yeah.
But I'm still glad that I did call it that, to be fair, because I think the people that actually know and get to know, they understand. But I do get it all the time when people say, well, you do residential as well. So yeah, we're a commercial finance broker, which basically just means that we do any kind of specialist lending. So it can be buy-to-lets, holiday-lets, bridging, development, commercial, so commercial for a trading business or for investment purposes. We do unsecured lending, asset finance, invoice finance. Best way to describe it is any sort of finance, as long as it's not, I want to buy my main residence for me to live in. However, as we just spoke about before we went live, is we can lend against main residences as long as the purpose of funds are investment or development. So sometimes people say, I've got your example there, client had 500,000 equity in his main residence. Perfect. We can gear up against that and use that money for further investment. So even though my party line is pretty much everything as long as it's not your main residence, except from that caveat where we can't actually use your main residence. But if somebody wants to buy their main residence to live in, but then there is a wee caveat to that as well. Like, so if it's a farm where you're going to live in it, we can lend on that. Or if it's like
This is a simple explanation, by the way.
He actually did say to me, going to tone this down a bit. This is me trying to tone it down. But like, so landlords that live above the pub, like, so they live in that asset. Yeah. So we can do that. It's all about the split between commercial and residential. So we had one this morning, it came through to us, and 60% of the property the client was going to live in and 40% was going to be rented out. So if you imagine two shops next door to each other and this townhouse above it with a big extension at the back, we can't actually do that without doing a split title, because actually 60% of that is residential. Now that would be different if he was going to rent out they two. So see they two residential, say he was going to rent them out, but he was going to live in it, and then his brother-in-law or sister-in-law or something was going to live in the other one. So that then classes as regulated. So the only way we could do that one would be split the title. A main residence mortgage broker does the residential side and we do the commercial. So we do them a lot with farms. So it's actually a really good business plan as well. So sometimes you'll go into these like really large farms to diversify them. They'll split the main residence off because you can get better loan to values, lower rates on main residence lending. So split the main residence off, get that on the higher loan to value and lower rates, and then we do the commercial side, so turning outside units into holiday lets, or this client wanted to start up an equestrian, so we were giving our money to do the equestrian side of it. So that really defeats my purpose of saying not against the main residence, because we can technically do it against them in some certain circumstances as well.
Right. So what about explain just to the likes of myself, investors, new investors, more experienced, bridging in a nutshell then? So the farms and all that.
It's honestly really, really hard to do. Like, I've tried it on so many videos, like 30 seconds in, I explain bridging. It's really, really hard. No, it's not actually hard to explain or what it's used for, but it's trying not to use terminology that people don't understand.
Yeah.
So basically, bridging finance can be used for short-term finance. So it's normally between 3 months and 24 months, but normally between 3 and 12. Some people think it only goes up to 3, 6, 9, 12. It doesn't. You can do 4 months, 7 months,
oh, really?
10 months.
I thought that actually.
Yeah. So a lot of people will say to me, "Oh, should I take it for 6 months or 9 months or 12 months?" I'm like, take it for 7. Like, so it doesn't matter what kind of months are in between. You can take bridging as serviced, retained, or part and part. So serviced means that you pay for it per month. So the same as your main residence mortgage, where you buy a house and you pay it back per month. That's the service, so you pay it monthly. Retained means that the money is deducted day one from the gross borrowing. So the gross is always before, the net is after. So gross will be before any interest and fees are deducted, and then net is after all that. Part and part's a different one, which is really cool actually. So I'm doing one for a client. So I'm doing one now. It's a client. It's based in Dubai, and he's buying a portfolio in Glasgow. It's already income generating. It's £3,000 per month, but he's going in, he's getting it below market value, doing refurb on it, and then the rental income's due to go up to £9,000 per month. It's like for the full block, so it's quite a big increase. He's looking for maximum day one borrowing. So instead of us retaining the full amount day one, we're servicing the £3,000 a month, because it's already proven income of £3,000 a month, which means all we need to retain is the difference. So the monthly repayments worked out like 4,200. So we'd only need to retain the 1,200 times the 12 months rather than the full 4,200, if that makes sense. Yeah. So it's a really good product for something in that scenario, because you're still increasing your net day one borrowing. So probably the best way to describe a bridge, and I'm going to use kind of simple terms for it, is say you're borrowing 100,000 and say your interest rate was 1% per month, which is actually quite high in today's market for a bridge, right? But I'm just giving that example. Instead of getting 100,000 day one, if that was 1% and that was for 12 months, you do £1,000 times 12. So instead of getting 100,000, you take away the 12,000, which is 88,000. So that's your interest would have been 12,000 if you kept that for the full 12 months. Yep. Then you take away the fees. So you would have the lender's fee, the broker's fee, lender's legal fee, title insurance, all that sort of stuff. So that then comes off it, and then that gives you their net borrowing. But as a rough idea of rates just now on bridging, we've got rates at the moment as low as 0.69% for residential. But like one of the ones we've got access to at the moment is like 0.75%, no lender's fees, no valuation fees, no exit fees. We've also got can be anywhere in the world. The client can be based anywhere in the world. We can do it from 25,000. So there's
25,000,
as low as that. But then that's only one lender. So another access to another lender at the moment where they're giving 100% of the purchase price, no more than 75% value, or we might have a lender that will give you 90% day one if their work's been done on the property. So what is really, really good about using a broker is we do have like 250, actually more than that, but around about 250 lenders on our panel. And we know which lenders to go to. We've got really good relationships with them. Like just before we come in here, you asked me a question, I phoned the lender and literally just like, it's just a chat. Can we do this? And it's all about having the really strong relationships with the lenders, which I think makes a difference between a good broker and a broker that maybe has a couple of good lenders on their panel.
Do you actually use all the lenders? I've heard you say that before, as a smaller percent.
So some of them the rates will be like 2% per month. Like there will be times. So I done one for a hotel and I tried top of the list down. But sometimes when you're scraping the barrel, you've got to be a bit like, right, why? So yes, the client was okay for taking 2% per month. It had a 2% in and 2% out. But from my point of view, getting involved in that, like I've got a caveat all over the place that, look, this wouldn't be anywhere near my first choice lenders because I don't do enough with them to vouch for them. Like, see, when it's a lender that I'm doing a lot for, like I know that their processes, I know that they're not going to like shaft a client over. Do you know what I mean? Whereas if you're scraping the bottom of the barrel, you don't know their reputation and stuff.
Before as well, like you just need to be aware if you go with a particular lender, the valuations can sometimes be about
valuations
a bit up and down. Whereas if you go with these ones, these are pretty good. You can pretty much be secured.
It's even what their valuation panel is. So if we've got access to certain valuation panels where we know that we can phone up valuers and be like, right, this is my client, this is what we're. Whereas sometimes we're not allowed to do that research. Sometimes they won't even let us know. So we've got some lenders that won't even let us know who the valuer is that's done the valuation. So there's not, and I'm not saying this from a trying to like do a dodgy point of view, but if you know that there's good valuers out there and shite valuers, which is the case, like you want it to go with ones that have got a good reputation. Say you want it to go go with lenders that have got a good reputation. Because at the end of the day, see if you're going bottom of the barrel with whether it is lenders or valuers that have got a bad reputation, it's not giving the best like outcome for your client. So
how does it, this might be more of a surveying question, but how do they actually work? Because obviously with these surveyors you can go out and instruct a home report, and these are still the ones that go out and do the valuations for the lenders. How can they come in so much off it at times? Is it just a lending appetite on that particular property? Because sometimes the comps are there and people are getting down values for no particular reason, and then you can never win the appeal.
It's you can never win the appeal, and it can go from lender valuer to valuer. Like I've had before where I've taken a client. In fact, I had one recently, and I won't name any other brokers' names. They went to another broker. The other broker brokered the deal on bridge and finance, then tried to exit that bridge and finance with the same lender, which I would never have exited with to start with. They then got nowhere even near what the end value was. The client came to me crying, saying, "Oh my goodness, I can't get out of this." The other broker only got it valued 100,000 end value, which wasn't even enough to take out the bridge, and we managed to get it valued at 140,000, which was then enough to take out the bridge plus give her more money to go on to do the next one, which was our full plan all along. Now that was just a case of moving. We move lenders and move valuers, but it is a bit of a tricky one because we could have that. We could go to DM Hall that might value with one like valuation, and then go get Graham and Sibbald out to the exact same properties that might come in 20 grand of a difference. So what I really hate and struggle with is I've got a client now who's actually on your group, and I feel dead sorry for him. He's purchasing a property and it's the one below his flat that he's living in the moment. He knows what the value is, but the seller told the valuer what he was selling it for. And now the valuers put that value on it, but we're all saying that's not the value though.
I've had that loads.
And I'm like, why did the wee man tell him? I was like, no, that doesn't get done.
But so is that to purchase though?
So it's a purchase.
But is that not normally, or because I've had that quite a few times with clients before, is that not normally okay because they're only trying to get lending for that value anyway? Or are you meaning more because the buyer starts going, oh, why is it valued at that? I thought it was valued at that.
More for the lending purposes, because we were doing a below market value transaction.
Right.
So because we were doing it below market value, but then actually the valuers say, no, that is the value of it, but that's not the value of it. That's just, but that's what he's agreed to purchase it for. Whereas if he hadn't told him that, then he would have had to actually do his own digging and do common sense on what it's actually physically valued at. Now, that's not us saying what it's going to be valued worth once it's done, because that will be even more again. We're just wanting to know what it's valued at currently in that position.
And is that just so you can get a higher loan to value for them and stuff like that?
Because we've got lenders that will go up to, so I've got an exclusive now with one of our lenders that will go up to 90% of the purchase price, no more than 75% of the value, day one, straight on to a buy-to-let. So that's not even doing bridge and finance first.
So slow down with that bit, right? Because that's quite good.
Right.
Because I was going to ask about that a wee bit further on, but obviously we're talking about, the days of the 25% deposits and 75% loan to value. Not dead, I suppose, but there's better products out there, isn't there? So explain that one, because that's quite a new one. As long as you're getting it below market value. So if somebody's buying something, because a lot of people listen to that, me talking about that, and to be fair, it might be my explanations on it, so I'm not judging people's for questioning me on it. You think your explanations are good, but you talk really fast through it, because it's just second nature to you. I get excited. I'm like, so with the products, the 90% one, most of them are because you're getting it below market value. So probably the main thing to think about is most lenders will not go above 75% of the value. Yes, we've got lenders right now that will do buy-to-lets at 80%, 85%, right? So on the full, these products, though, that I'm talking about are like 100% the purchase price, no more than 75% of the value, or 90% the purchase price, no more than 75%. So all you need to remember on these products is it's 75% of the value. You get 100%. So you'll get up to 100% of the purchase price, but no more than 75% of the value. So if something's valued at 100 and you're buying it for 75 grand, that's 75%, you're getting 100% funding there. Yeah, the way that I always do is I write it out, right? So I go purchase price, let's say 100,000, right? So purchase price 100,000. So on that, you would get 90% on this one I'm giving you. So 90%, I'll write it down beside it. The value is 120, right beside that 75%. It'll always be the lower of them two.
So write it out beside each other, and it'll always be the lower of the 90% of the purchase price, no more than 75% of the value. So whatever that figure is between them both is the figure that you'll use, the lowest of them. Right. So that means if you're buying something, you just take away what the purchase price is, take away that figure, and that's your deposit in between minus all your legal fees, taxes, all that due. But that's the buy-to-let element of it. So there's products available like that. There is just standard buy-to-lets where you can get 85% loan-to-value straight day one. We've actually got a holiday let one there now as well. It's 85% straight day one against the current value.
You're not doing that yet?
There's a lender that's dabbling in it at the moment. See, the only thing I would say with all these is a lot of them will say they do it. Lucky enough, this one that's a 90% of the purchase price, no more than 75% of value. I've now got 8 through them and I've no kickback on them at all. However, some of the other lenders that say, we do like that 100% of the purchase price, no more than the tick boxes you've got to meet to make that. Sometimes I'm like, chings, like, am I ever getting one of these through? Do you know what I mean? Like, so yes, there is lenders out there that will say that, and they'll say, we'll do 90% of the current value and stuff, but what you've got to tick to meet the criteria to get that is difficult. So the way that I explain it with my spreadsheet is, I've got a massive spreadsheet with all my lenders, and then you filter it down. So if you filter down Scotland straight away, there you go, most of the lenders are gone. Right? So you're left with this wee tiny spreadsheet of lenders. And then you filter down by borrowing amount. So say it was below 100,000, you've then taken away most of the other lenders, and then you filter it down to no background experience or no background income or whatever else. There's caveats here, and that will then filter it down and down and down till you get to 2 or 3 lenders left. Mm-hmm. So that's like the best way. You've got 250 lenders, but actually out of them, how many are going to do that scenario? Like, so then I've done one recently for a client that was based in Nigeria, never been in the UK before, and we still managed to get my buy-to-let property. Like, I've done one for a student that was living at home with his parents. He was unemployed, wanted to go on the property market. We've managed to get him like a buy-to-let. So yes, there's scenarios where they're really quirky where people go, no, there's no way you could get that. But normally, it's very, very rare we say no, but it's at what pricing that comes in at is where the difference is. And to be fair, the ones with that client that was in Nigeria or the client that's living at home with his parents, the rates aren't crazy, and it allows you to get on the market and start your property journey. But it's just knowing that you might have to kind of bear the kind of higher rates for your first 1 or 2, and then once you've got them over the line, then the options are a little bit, because you're a little more experienced. Because some lenders will have like a minimum 24,000 background income, some will have a minimum 2 background assets, some will want you to have done a flip before, but some won't care. You could have done none, and it doesn't make a difference. So it's just about finding the right lender to suit what your like tick boxes are.
And do they change the criteria all the time?
All the time. All the time. Like, I would say a massive part of my job is just filling my spreadsheet. And it's a really boring job. Yeah. And see, the worst thing is lenders just send me their leaflets, and I'm like, no, I can't read it. I need you to phone me. Like, I can't take that in a bit of paper. So then I'll need to go through it all with them, and I'll need to explain this to me. Why would it be like that? And why is that changed? Just send me a leaflet. No. I should send one ear and out the other.
What about portfolios then? Are you getting, what sort of rates and loan to values are you getting? That then now again, is it just the same sort of stuff, depends on just the discount and whatnot? Like, so why you're getting a property below market value or why you're getting a portfolio below market, it's easier with a portfolio because you normally can get, because it's a group and it's easier for them to sell. So but I've kind of jumped there, but and the below market value thing in general, that is a question we get asked, is why you're getting it below market value. And see the whole thing, I got it from a property source. I know. They don't like that. Don't I know. That is one big takeaway for this podcast. You never tell lenders you're getting properties from sources.
Straight away they'll be like, no offence, but they don't like sources. So yeah, don't say that. But the property portfolio thing in general, so if you're getting a property portfolio and they're saying like, what was your question? Sorry, your question was
portfolios and the sort of loan to values and stuff you're getting, interest rates.
Loan to values. So it depends again. So see if you've got a portfolio in Aberdeen versus a portfolio in Glasgow City Centre, that would make a difference as well. Also, if they're all in the same block or if they're all being sold from the same seller, which also falls in with your whole ADS, MDR, all that sort of stuff. Don't ask me about that as well though, because honestly that's a full scale, you need a solicitor on there for that, because that's a grey area on its own.
Some solicitors will do it, some won't, and stuff like that.
I should just say to people, just phone around like 3 or 4 different solicitors until you get the answer you want, because honestly, I'll speak to different solicitors, they'll give me different, and
I used to think legal,
legality
and it's just black and white. Exactly, and it's not. It's
so many grey areas. And then I end up thinking, scared that I give the wrong advice because we're not legally trained. So I always say, okay, so this is what I think, but I might be completely wrong. Just check your solicitor. It's the same with tax as well, though, because we're not allowed to give tax advice. So I'm like, right, so in this scenario, like what I see is sometimes people set up like this, but we're not tax advisors, so you're allowed to check your accountants. You're always having to caveat yourself. But portfolios, it's the same variations. So loan to values, round out between 75 and 80%. Rates, anywhere. Honestly, rates are changing all the time at the moment. But what I would say is the trend we're seeing is definitely coming down. And we done a review with one of the tier 1 banks the other day where they see their trajectories going, and it's all coming down as well.
Is it?
Well, that could change, especially the fact there's like a world war going on, so that really could change it like overnight. But yeah, I think from what we've been told that they expect the base rate to continue coming down. They wouldn't give us an exact figure on where they expect it to be, but that is like, there's so many things that could affect that, like the war in like Russia, Ukraine affected it, but now this is going on and oil prices are going up, like all that sort of stuff can have effects on it. So what you would hear last week could be different next week. And that's where the whole fixed or variable rate is important for people, because their attitude to risk. So if they are more risk averse, they might want to consider, are we going to fix our rate, or do we not really mind if that goes up? But then we've got some lenders who allow things like with fixed rate unlimited overpayments, no early repayment charges, whereas sometimes if it's like a fixed rate, you know that if you have to come out of that within 3 years or 5 years, then you're going to have an early repayment charge to pay. That's another. So one of the main things that I look at when I'm speaking to a client is what is important. Is it speed? Is it rate, like being the lowest? Is it flexibility? Is it process being easy? Is it to have a relationship manager at the end? So some banks will offer relationship managers to help with the guidance on that, because these are all really important. Like, so I had one client that owned a garden centre, and the main thing he wanted was a really good relationship manager at the end of it. Like, that was his main priority. I'm doing one now for a client where we're doing a bridge. The valuation came in so much lower than we expected on a commercial property. So we've then had to refinance one of his buy-to-lets. That buy-to-let wouldn't have went with the lender that I would have chosen if it was going with rate, but we needed that on a desktop valuation. We needed it completed in 3 weeks. So the lender I went to was different than what I would have went to if he just came to me 2 months ago and said, I'm looking for like the lowest buy-to-let rate on the market. Do you know what I mean? So it's all about what they're really looking for. So flexibility is big on. We do a lot with more on your trading business side of things as well. So that's actually my background before doing like brokering, as I worked in commercial mortgages for HSBC. And it was all trading businesses. So we were helping businesses acquire other businesses. We were helping businesses grow. And that side of it is really exciting as well. But anything to do with that, that's really important with what their goals are, because like flexibility on overpayments can be really crucial for a business, being able to like overpay as and when they want, or even the movement of money through their businesses through holding companies. So if you've got like group structures and how we're going to structure the businesses within the lenders that we're looking for. So that bit's a wee bit more juicier than like buy-to-lets and things, but
it seems like you just do so much more than just the stuff that I come to you for. I've got this refinance or this purchase or whatever. Like, there's so much going on in that world, isn't there?
I know, that's why my brain is like all over the place. I would say commercial mortgages and trading business and stuff are really, really exciting. So even yourself with your trading business, that's what I say to you, there's so many opportunities just out with property that you could be looking at to scale your business. So whether you wanted to acquire another business, or look at all your machinery around here that you've got, or your vehicles, or let's say, for example, you were wanting to grow, so you wanted to take on a marketing team, you were looking for some cash flow funding, or you wanted to, that unit next door come up for sale, you want, or even it wasn't for sale, it was just leasehold. Some people think, I can't get funding because it's just a leasehold. No, we can help you with a purchase of the leasehold, so we could cover the first year for you, and then we could help you with the refurb or the fit out for it. So there's so much money actually available for trading businesses. We help startups as well, but startups is slightly harder. We're just done one now for quite a big restaurant chain that are growing. Like, so it is doable, but you just need startups, you need really, really good projections and a really solid business plan. It can't be something you've done in ChatGPT. It needs to be like accountant prepared and stuff.
Yeah. It's mad because I bet you a lot of people don't really know that as such. You would just think, I'm going to start a business, right? What money have I got here? Oh, it's not enough. How can I do it? Whereas if they spoke to you, there might be a route.
And see, even if we can't help, we can put them in the direction of like grants and stuff. So even when I started my business, I had to refinance my main residence to take the money out of it, because the way that it works with our business is we don't really get paid for like 6 months after, or depending how long a deal takes, right? But I always base it on, it could take up to 6 months for this to go through. So if I do something and then I don't get paid for it for like 3 months, you're always a step behind. So when we like started the business, I had to refinance our main residence, take the money out, but also got applied for grants. So we got £6,000 from one grant. We also got like some money towards some staffing and stuff. So these sort of things are available. Like Vicky, she's doing the same now because her company's reasonably new, and there's things that are definitely out there. It's about speaking to the right people. Like Business Gateway helped me.
Is it easy to get them though?
Yeah.
I'll be honest, when it comes to grants, I'm always like, grants, I bet that's going to be such a pain in the arse to get, and I just don't bother.
So I suppose at the time when I was applying for them, I wasn't as busy because I didn't have as much of a client base at the time. So I probably had more time to put into doing the application for it.
Right.
If I've seen how much it probably took me in total, maybe over the space of like 3 months or when I did it, maybe took me about 12 hours.
Right.
But at the time I needed the money, do you know what I mean? So it's like...
What was that like then? Just like going back to when you were coming from...
Terrifying.
Aye, because I remember I spoke to you, I was using you back then as well, and it was like, it's such a massive step in it, especially I think in your world, because you've got all the... You need to get your own compliance and everything like that,
so
cost money and
scary,
everything. Aye, so I talked to us about it.
Well, that part there was scary because I was on like a really high salary as well.
Aye, so right.
And I like supported mum and dad at the time as well. So financially, it wasn't just like me, Marty, and the kids. Like I had a lot on my shoulders.
Right, aye.
So when I left, it was very much like, right, I have no choice. And Marty was working with the Prince's Trust at the time. I think his salary was like 25 grand. So it wasn't as if we had anything. We had quite a big mortgage over our heads. So I was like, I had no choice but to make that work.
Yeah.
But I've always kind of been one of these people that was just, once I get my mind to it, like I wrote all my own compliance documents myself. I just wouldn't sleep basically with the best outfit until I had everything right and ready to go. But at the start, probably was easier because you aren't as busy. So I had time to do stuff that if I had to do now, I would not have time to be able to do. So it allowed me to build it bit by bit. And now then we just take on different staff members, which is the scariest thing as well. Like, first of all, recruitment is the hardest thing ever. And second of all, make sure you're getting the right people that you can trust.
Yeah.
But that's it allowed me to scale. It's allowed me to then put trust in people to do other things because I'm a bit of a control freak. But now I've managed to learn that I physically can't do it all. So I need to give things to other people to do. But yeah, it was absolutely terrifying. Like, I don't regret it at all, but I would say that year was really, really, really hard for me. And then my mum took not well. And that's probably the biggest thing I would say about owning my own business and not having enough people being able to do what I can do in the job. Was probably the hardest thing for me. Was my mum went into a coma, and like she was really, really ill. Like we got told she wasn't going to make it, and I was, which actually people would totally judge. But I was actually sitting while mum's in a coma, I've been told, and I had my laptop on and ICU working, and like everyone, like my aunts and that were coming in, they were like, Emma, this is ridiculous. Like, put her laptop away, and I'm like, you just don't understand though. Like, I need to pay the bills. Like, if I'm not doing that, I can't pay my staff. If I'm not doing this, I can't pay our mortgage. Like, I can't pay mum and dad's mortgage. Like, I don't want my mum waking up and not like. So it's easy enough for other people to say, "Oh, you work too much," but when you've actually got so much responsibility in your shoulders, you don't have a choice. Like, so, do I regret? Like, my mum didn't even know I was working there, so it's not as if I'm sitting thinking, "Oh, that was." And my mum has pulled through, and she's like doing well and stuff. Do you know what I mean? Brilliant. So like, but would I have sat there and if she'd passed away and been like our last days, and I don't know, like, and also I thought that could have given me the wake up call, like, because I do work so much, like that I should spend more time with her. And then actually 2 months after I had my mum, our best friend, get diagnosed with stage 4 cancer. And I was like, okay, that's a wake up call that I needed to like stop working as much, because it's in. No, none of these have given me the wake-up call that I needed, so...
You said to me a couple of months ago, you're like, I'm just watching what I do in my time and all that now, so you've got a wake-up call for somewhere.
Like, well, I try, like, but I'm really shit at it. Like, I'm getting better in that, so we're taking on more staff, which will help. So we've got somebody starting in August that down in London who's going to be absolutely phenomenal. And then we've got another 2 girls that we've interviewed over the last week. So we're going to be up to a team of 10 probably by August, which is really big in such a small space of time. So it's just getting more people that can do what I can do in the role. Where we've got really good at the moment, we've got good support with people that can do other things, but I'm really the only one that can actually broker at the moment. So I don't physically get a holiday. It's not a thing, because the clients always need me for, even if it is just a 10-minute per call, they still need me at that point.
But when you want to go on holiday then for a week or something in the summer?
I have to work for it. Every single holiday I've been on, I've had to work for at least 3 hours every day.
Really?
But that's been for about, because that was even my previous company, so like probably about 6 years I've been like that. Like I've never actually
just became part of it now.
Yeah,
that's what
like,
it is.
So with me weaving, this is where I get massive mum guilt, and I'm not saying this is a great way to be in the slightest, but my kids rarely see me without my laptop. Like, so it's just normal that my laptop's in front of me. This is how bad it is. Even when we're going a journey and Marty's driving, my laptop, I'll be typing while I'm in the passenger seat. Like, I don't even enjoy the views. I don't enjoy the music. I'm just like, I'm like a machine. Do you know what I mean? Like, I actually get to a stage, I say to Marty, I feel like I'm actually just a robot. Like, I'm just always on, like, but I know it won't be like that forever.
Exactly.
Everyone, and I'm very much aware that, like, everyone said to me, the first few years of business are the hardest, but it'll be pay off. And it is paying off. Like, I can see what's coming in about it. We've just moved into a lovely house. We get to go on holidays. Like, we're going away for the World Cup for 6 weeks. Like, I would never have been able to afford that before, like, at all. We would have been lucky if we got to Craig Tara for a week. So, like, I get that, like, we're getting the benefits from it, but I just need to have, like, I need to be able to switch off. So taking on these people like that can do my exact role in the business is really, really crucial for me not to. And this whole burnout thing, I probably didn't believe burnout was a thing before, but recently I think I've told you I've had this pure shite shoulder, and every time I go, I'm like, there's something wrong with me. I'm perimenopausal. I've got this, and they're like, no, everything's fine. This is fine. You've not got diabetes. You've not got this. And I'm like, well, what is it? And they're like, your stress levels. And then they gave me this wee watch, and it's like, your stress levels are functioning at like 95% stress rates. And I'm like, I'm not even stressed. Like, I'm totally fine. And then I'm okay. Like, that's probably like, so I think from my own personal point of view, I just think I need more people that can do the top level stuff. We've got probably built it the right way. We've got the foundations really good. We've got great systems in place now, like see our actual physical systems. They're scalable systems, you know what I mean? So we could, if anyone goes off that's in like an admin support role, I could get somebody into that dead easily. So every other role round about me could be easily filled with the functions, the systems, all that. It's just me really is the bit that we need, maybe 3 or 4 of me up throughout the full of the UK as well. Because Glasgow, it's great, I love Glasgow, but property prices are really, really low compared to down in London. So like when I used to work for my previous company, I would do like 22 deals a month, and somebody down in London would do 5, and his 5 would be more income than my 22. So if you imagine, my legs are pedaling 10 times harder than his, because I've got to do more to make up for that. So I really want to get into Manchester and London.
Is that what you're hiring somebody down there for then?
Yeah.
To just try and take
so somebody in London and we've already got Danny in Manchester, but somebody else down in Manchester as well. So I want one in the 2 big cities down there. We've got a presence over in Northern Ireland at the moment, but Northern Ireland's similar to Glasgow, where the property prices are great. It's actually even harder to get lending over in Northern Ireland because there's even less lenders there.
What were your lender? No, your broker.
What?
That guy.
Aaron?
Aye.
He's amazing. Oh, Aaron, aye.
No, is it Aaron?
Aye.
Is it Aaron? Aye.
I know, he's amazing. He's so
good.
I know.
So, different spin then. So, see for example, obviously, in the networking out with, people have like maybe 20, 30 grand, right? So they come to you with that sort of pot of money. What sort of product are you introducing them to? They maybe get a property that's 80 grand and they think, oh, can I afford this and stuff like that? There's products there for them as well. Because that's been a big thing, I think, recently. I think your money can go a lot further now, because I still speak to people every single week and they're like, so my 25% deposit, they never get this, never get that. And I'm like, no necessarily anymore, So what would you say to them?
If they're, a lot of times actually, and I'm not just saying this because I'm on your podcast, but a lot of times with that, I would actually tell them to come to someone like you first. I know you're probably asking the question where you're saying to come to me, but a lot of times I'll get people that phone me and say, I only have 20,000 deposit or something, and then obviously we'll ask them questions like about similar to what you won't maybe say about what we've done with your parents'
No,
house? So basically what we've done with someone like you, so I'll ask the same kind of questions to them, like, is there any equity? And then I'll sometimes give examples of someone like you, or we've got a couple of other clients who we've helped where they've like geared up on like their parents' main residence or a family's main residence or something like that. They've got background equity if they're wanting to go bigger with their deposit. But if they've only got 20,000 cash, I would come to them if say, because a lot of times they'll come to me and say, right, Emma, I've got this, but I've not found the property. I'll be like, I can't help you with that part. I'm sorry, I'll be able to help. But I would actually kind of more swing them more towards you and say, right, if you can get a property below market value, for example, or if you're going to do a joint venture with someone, then you might actually have more to put into the pot. But if they were just coming to me straight from you and they were saying, right, found a property, I've got 20,000 to put in, and it's if they're getting it at that below market value or value, and if they're really what they're at purchase price, because once again, if it's below that 100,000 mark, then the lenders you've got available, so it might be that it's just a 75% loan to value, right. But there is so many caveats in there as well, because even if it's a trading business, so we done one the other day that was a client that had a trading business that was trading really well, but he wanted to get into property but didn't have any money, and I was like, do you have money in your business? And he was like, I don't want to use that as my cash flow. And I was like, well, why don't we look at doing a business loan to your business? Because then you can actually lend money to the business, but actually, and I was like, why didn't I ever think of that? Yeah. Like, so it is about just looking at the full picture of the individual. Like, do they have background trading business? Do they have...
Because they don't understand that can have a positive effect for them.
Definitely, but there's so many options. Like actually, I've been using this place recently to go, and it's like you go in the cold water things and all this. It's me trying to...
It's Soul Sweet or something like that.
It's one called Dopamine, so it's really good. But it's me trying to get my chill time and all this. But we were even then talking to him with different examples, and like he was like, why did I not think of that? And I was like, sometimes you just need somebody to say it to you. Sometimes you just need to talk it through to someone. See, if you're saying to someone, right, this is what I've got, this is what, like, you don't even know, you don't even need to know what you want to achieve, because somebody says you want to achieve, who knows what you want to achieve? So just tell us what you've got, everything. And sometimes people are a bit sceptical, well, why do you need to know about that? Or that's not to do with this. And I'm like, well, no, but just tell me. And that's how it's good going into somebody's business, because you can see it. Mm-hmm. Well, look, they've got a printer over there, or look, they've got a fleet of vans out there, or they hear them on the phone, and you're like, wait a minute, you could actually get money from this, or you get money from that. So sometimes seeing it and feeling it is better. But yeah, I would say with that guy with this scenario with the dopamine places, we were able to say to him, right, this is how much you're paying out rent at the moment. Actually, if you bought the commercial premises, it's more than less than half than what you're paying at the moment, and you're going to own it in 10 years. It's like an actual no-brainer. That's
one of the things in here when I've got this. It's like the rent. That's like, could they buy it and stuff? And I didn't even make the offer or anything, but I'm just like.
So that's another thing to look into, and this is where I was talking to people as well. See if you're not going to buy it, look at it, put an option agreement in place, though, because you so let's say you do the property up, and then you decide in 5 years' time you want to buy it. If you get an option agreement in place that you put in at the start, then you get to buy it for what it's valued then rather than what it's valued later on, because most assets are appreciating in value rather than depreciating. So it means that if you put that in right at the start, then if you don't want to buy it, you don't need to, because it's an option. But it means that you add value to their site, but you get to purchase it for what it's worth now rather than what it's worth later on.
Okay. So in terms of that gearing up, because Darren, who was on the probably coaching intensive at the weekend there the first 2 days, he's got a portfolio and stuff like that. So I wanted to kind of touch on this, because I think this is just a phenomenal strategy still that a lot of people still don't know about. I've spoken about it quite a bit. I know you have as well. But tell us exactly what that strategy is, and again, the most basic terms you can, and how beneficial it actually is. You don't even see the cash and stuff like that. It's just amazing.
So let's use, that can be anyone's property that agrees to it, obviously. I'm going to use my next door neighbour side. Anyone's property that agrees to it. So family members are obviously, so your example, parents' house, main residence, can be valued at absolutely any. It could have borrowing on it, or it couldn't. So sometimes people think, I can't use it because it's already got a main residence first charge mortgage. Doesn't matter, as long as there's enough equity there for us to use. So you can just use that property. You don't need to use a target property as well. So it all depends on what you're trying to achieve. So we done one the other day from somebody that came from your group as well, and they had a background assets worth 300,000, no borrowing on it. She was like, can I use that plus the target property? And I was like, well, you can if you wanted to buy something at 500,000 or you wanted to buy 5 properties at 100,000 each. But if you only want to buy one and that one's only 100,000, then it's 50,000 to refurb, then you don't even need to use the target property. We can just use that. There's enough equity in that property to use. So it really depends on what you're trying. If you're wanting to, because some people think, I don't want to take enough out to do 5 at one time because that's too much for me, or nobody will want to take on a big project, or there might not be that much equity in it. So if, let's say, for your background asset only had 70,000 equity in it, let's just say, and you want to use that 70,000 plus the target asset. So let's say the target asset was 100,000 and you were going to spend 20,000 on it, and then you were going to sell it at the end. You could then take security over the target asset and then a second charge or a first charge over this background asset to get 100% borrowing, 100% to purchase it and 100% the money to do the works. But you don't ever take that money out, so it's not like a monthly repayment, because this is another thing, is a lot of people don't have background income as such, so they'll go, I can't touch my main residence because my income's not very good, or I just retired, or I decided to go full-time in property and I don't have that anymore. That doesn't matter. We don't look at the background income as long as there's enough equity in there and as long as we've got a repayment strategy at the end of the 12 months to repay that. That's all that we're looking at. So it's not as if the money comes physically out as far as a monthly repayment. We're just gearing up on it to take that money to use, whether it's to buy a target property. As long as that money is going to be used for investment or development. If somebody says, I want to take money out of that property to go on holiday, we can't use it, but actually we can use that property for technically whatever you want that's got business or development under it. So I want to buy a piece of land and build a house on it, as long as you're not going to live in that house. So if you're going to sell it or rent it out, or I want to buy a commercial and turn it into residential, like that can be used. That all you've not got to think about is that property that's in the background is how much equity is in it. And we can use that to basically take the money out of that. The main thing you've always got to think, though, about this product is how you're going to repay it in 12 months. Because see, if you're going to buy something, you're going to retain that. And then when you're then only getting 75% potentially out in 12 months' time, is that 75% enough to repay the charge on this property and the charge on that one?
That's a big thing that I was actually going to touch on, and you have just touched on it, because the twice that I've done it was a 1 to 2 bed conversion in Byers Road, sold it on, paid it off, made profit. The second one was the Nova Gardens Bishop Briggs, converted the attic to the 3rd bedroom, sold it off, flip profit, easily paid off. But if you're looking to refinance, you're pretty much needing to be taking out all your money on that deal, plus make sure there's enough there for the interest, and make sure it's all paid back.
I always would say it's slightly riskier, well, not slightly, it is riskier doing it that way. Like, so if a client comes to me and says they want to do that and they're wanting to retain it, I'm always very much like, you need to be so certain on your numbers here, because all it takes is for you go to sell that property and you sell it 10 grand below, your cost for doing the works are 10 grand over, and this isn't going to work, then you're going to be left with a mortgage or a charge against your background asset, and you need to be able to clear that off. So, and nobody wants to chuck their parents out their main residence, because actually at the end of the day, the realism is that's a charge on that, and if that's not repaid, yes, you could obviously look at rebridges and things like that, or you could then look to put it onto a main residence mortgage or something. So there is sometimes opportunities, but the realism is there is a charge on that main residence, and a lender can call upon it if they don't get repaid. So you need to be certain of risk. That's why I would say it's more a strategy that if you're going to be flipping properties, because you're going to get 100% of your money out, not just 75% or 80% or whatever. Do you know what I mean?
So talking about the bridges then, so the standard is like 5% if you go beyond your term, even by a second. There's defaults, just no saving it, is there?
Yeah,
is there?
So default fees, it's not always 5%. Some lenders are only 2%.
Is it?
I say only 2% as if that's little, but it's just about being prepared. So this is one of the biggest things I'll say to people. Is people will say, I want a 6-month bridge because I'm getting more net day one from it. However, I really would like, we can't give advice, so I can't say I would advise against it, but I would consider against it, because if you go on a 6-month bridge, and yes, it might take you 4 weeks to do the works, and you plan to get it on the market straight away, but all it takes is for whoever's buying that's in a chain their sale falls through, you need to remarket that
It's
again.
even a 6 month rule though. Because then like that Halifax, the residential lender are going to say I want it 6 months.
Definitely.
And if it falls
so
through,
that's why
you're
some
snookered.
people say to me, it will just take 7 months, because then they know that their seller's not going to have that 6 months, their buyer, sorry, is not going to have that 6 months through.
That's risky though.
I know.
Because if it falls through 4 weeks into conveyance and they need to
Exactly.
remarket and all that.
And it's a big stress for people. I would just say take the 9 or the 12 months, and then if you only take that bridge for 3 months, you only pay the interest for 3 months, not the 12. So yes, you might be getting less net day one, which actually wouldn't make a difference if you're gearing up, because that wouldn't actually make a difference on that at all. But if you were like taking that 12 months time and you pay that off in month 2, you pay that up in month 4, you're only paying the amount of interest for the time you have it. So just give yourself that wee bit of leeway so that you're not paying the default fees, because a lot of the lenders are, even though we've got amazing relationships with them, I've only had one time that I can think of when I managed to get the default fee waived.
Really, aye.
Like, so it's not like done often.
And was that like due to like a right personal circumstance or something? I bet, something like that.
Yeah, like as in like death.
Aye, somewhere. I thought it'd be something like that. Aye.
Really blunt there. So.
Right, fair enough. So I talking about like just some of the mistakes or fuck ups basically that you've came across that maybe developers, investors have done. Is there any majors there?
I would just say people like a lot of times we'll get people that will come to us and I'll say, what's the build cost? And they'll go, 200,000. I'm like, you've not fucking done any of your due diligence here. You've literally. So then I'll go, we do all the figures and that's 200,000. And then a QS will come out, they'll spend all this money on a QS, the QS will go, no, that's a 300,000 development there. And then all of a sudden none of the figures work. And then the client's like, that's not working for me. And I'm like, it's because you plucked 200,000 out your head. So I would say just do your due diligence. And see even things like speaking to estate agents on what's this going to be worth once it's done, because people just like to pluck numbers out their head on what they think, but actually do desktop valuations, like speak to local estate agents, speak to valuers. Development is probably the one I see going wrong the most, where people put so much money into a development, walk away. And I see the amount of times that I see them losing money out of it. And I'm like, you've spent 6-9 months of your life and you've walked away and you've lost money. Like, and I sometimes can understand it if they weren't doing it for the intention of making money because it's a long-term investment, because they're putting on a short-term let and they can see the potential in it. Then they might not actually care that the fact they've not brought all their money back out again. That's fine, because they might be making X amount per month and that was their actual goal from it. But when their goal was to take the money out to allow them to take that to move on to the next one, and they've and I suppose people learn from it as well, but I would say that getting your numbers really as accurate as possible up front, getting more than one quote. Even myself now, we're doing an extension on our property, and the guy that's been giving us the quote, it's a really nice guy, but it's taken him 8 weeks or something to give us a quote for it. And then I was like, tomorrow, I was like, we can't just get one quote. That's just like, we've been saying it to that. So then we're going to someone else for a quote. And then I'm like, we're going to be like 4 months down the line and we've still not even got anything started on this. So I would say that just try and be as prepared as possible. I know you just talk about this on your groups, having a good team around you is so important with things like that. Like just people that you can bounce off of and know who to go to. And I
always say though, it's like having the right people. So you and the right accountant, the right solicitor.
Definitely.
See the amount of people I speak to and it's like, I've got a broker for down south and I'm trying to buy something up here. I'm like, no, that's not the way it works.
I don't mean to slag any brokers down south, but most of, actually a big chunk of our deal comes from brokers down south, because they know they don't know the market as well up here. So they'll be like, why? It's a bit like me, I can do asset and invoice finance. I don't actually do that in-house. I pass that to my invoice finance guy, because yes, we can do it, but it's not my lane. So stick to my lane where I know I can do it really, really well. So if you're trying to dabble in Scotland, but the Scotland market's so tight on what it knows, you're going to miss out lenders, because you're not going to know everything that they're going to offer. So I don't really understand why somebody would use a broker down south.
So see, just jump back to say you do go over the bridge, because there's this thing where you've got security over the property and they're just going to take my house off me and all that sort of stuff. So that's obviously the very last thing they would ever look at. What do they actually look at first of all, second of all, third of all?
So it depends what security you've got in place, but it would be, first of all, remember they've only got, say, 75% loan to value as well. So a lot of people think, I don't want to give a personal guarantee because they're going to come after me for this. remember their first port of recall would be to sell the property and get their money back that way.
Yeah.
And realistically, because they've only gave you 75% of the value, as long as that sells for above that, they're going to get it back. But a lot of people worry like, oh, I'm not giving a personal guarantee because they're going to come after me on that. They actually really shouldn't have to. Obviously, that everything happened to crash, so people are a lot more sceptical and things like that, which I do understand as well. But what the kind of process would be is it goes to past default. They'll work with you. They just want their money back. Like they don't, for a bank to take you to court for their money costs them far too much money to be bothered with it. Legally, I've never actually seen it going down that route.
Yeah.
No, like I've never actually seen it came to. I've seen repossessions from the other side where the banks will phone us and say we've got some repossessions here or whatever, but I've never actually seen it from any of my clients being repossessed. I'm not saying they never have, because maybe they have and I've just never known about it. But I've actually physically never seen any of my clients actually being repossessed on anything. So yeah, I don't actually really know, like from the legal perspective, how that works, but they work with you is what I would say.
It doesn't actually happen often at
I
all.
would say that it does happen, because obviously I see it from the other side where we've got repossessions. I would say it's more from trading businesses though than anything else, because a trading business could go downhill quite easily, like a management dies or like a certain sector, like so if you think of the hospitality sector at the moment, like with the amount of taxes that are bringing in place for like on the rates that these, like a lot of these businesses will go down the drain. So if they own if they've got lending out, that's a lot more likely. But actually with a property where you're just funding a property that's 75-80% loan to value, worst case scenario, you don't pay that, they sell the property and get their money back. Like, and that's all they want is their money back.
And that's the thing. It's like, see if you're buying a property that's so run down and you get a bridge and then you do a month's worth of renovation to it. Now, you've bought it at a discount anyway. You've done a bit of a renovation. Something hits up where you can't, like the value's increased. Yeah. And it was already increased based on maybe the loan and the discount and stuff like that anyway. So it should be easy enough.
We're obviously, it's a wee bit different, and you probably won't see it as much because you are mostly for below market value, but we get a lot of clients that are paying 20, 30, 40 grand over home report.
Really? Aye?
Yeah.
Why?
Just mainly if it's like,
where
so,
are they?
You want them, but I suppose areas, like so if it's specific areas, or if it's got potential to go into like an HMO, or if it's got, if they're looking at what it would be like, so up in like Glen Eagles or whatever, and they're looking at the holiday like potential, like we've got one now where they're buying like an old guest house and they're turning it into, they've got a link to like American golfers and they're going to be bringing golf tours over, so they're paying way above what the home report is on the basis of they know that's going to even itself out quite easily. But that's where if something was to go wrong with like a repossession or whatever, if you're paid way over home report, then obviously you could lose out on your money as well because you put so much more in on top of what even the value was of it.
Yeah. Okay. So what's the fastest deal you've ever done? Quickest you've ever get anything over the line?
So in general, actually, the majority of deals can go to legals in 24 hours. That's actually standard. So people say to me, I will come back to your question. I'm not actually like skipping over it, by the way. That's like a politician that does it, here. I'm not answering that. Yeah. But I would actually say the majority of deals we can get to legals in 24 hours. It's actually the legals part that takes really long. So people say, well, how long will this take? I'll say, we can do it without a valuation, so if we can use home report or desktop valuation, then we can normally get it to legals in 24, 48 hours. It's that, but after it would take a lot longer. If you're doing a refinance, it's easier as well because all the titles and all that are already done because they've already been done when you purchased it. So say you've done a bridge and then you're exiting that bridge, that process at legal should be a lot shorter as well because all the searches and all that are already done. So if you were doing a bridge on a refinance, you could easily get that done in like 2 weeks. The fastest deal I've ever done was a week, right? But the rates weren't even good. I wouldn't even say was, really? But I have seen them being done faster, and I personally haven't myself because you have to drop absolutely everything to do it, and I just don't actually know like how much that's then fair on everyone else. That you're a bit like, well, these people are more important to me because they need it done in 2 days. Like,
but see, in terms of refinance, I get asked this question at the weekend there, and I just say it's about 6 to 8 weeks. But if you start a refinance today, when are you expecting that money to land back in your bank? What's the sort of average now?
Average, I would say, on a refinance is 6 weeks.
Right.
Yeah.
Okay.
Purchase, and that all depends on whether you can use a valuation, because that's a big difference as well. If you're doing a refinance and that's you exit a bridge, you've increased the value, you wouldn't want to do a desktop. You would want a valuer to go out. You're then adding on 2 or 3 weeks to it. Do you know what I mean? So anything that you've got to add on a valuer, the valuer can take up to 10 working days to get the report back to us.
Mad, isn't it?
So straight away, we always say there's 3 weeks going out that window.
Yeah.
Like, but if you can do it without, which a lot of times the desktop valuations are coming in like pretty decent. Like I done one for a client yesterday and he was like, that desktop valuation's higher than what he assumes the actual value would be. So I was like, excellent, let's go with that.
What's the worst situation you've ever had?
Like deal-wise?
Deal-wise, client-wise, anything?
So there was a client down in Wales and the lender, as I was saying, scraping the barrel with like lower tier lenders, and he'd paid all his valuation fees, everything got to the end and the lender pulled out.
How much was he out?
About 16 grand.
Was he? Mm-hmm. Quite a big one then. Quite a big deal. The lender just put out last minute.
Like, so this is the thing with unregulated lending, is there's no recourse on these lenders.
Yeah.
So
they don't care.
So I refunded all my fees. So I'd worked in that case for a year. Like, so it's not as if I'm doing this like obviously I do it to make money as well. Do you know what I mean? Like, and that client, so he got all my money back, but he didn't get any of his valuers. His own solicitor still charged him because they still done the money, so still done all the work. Here's me not making zero out of it. He's out of money. The valuer still makes their money. The legals still make their money, and the lender just walks away from it.
Like, just terrible, that, isn't it?
I know. So that's your issue with using really, yes, there could always be a lender out there for you. But see, when there's lenders that don't really massively care about their reputation, then they can pull away from something at the last minute. But see, if you get like a lender that if they do that, then you can put it on socials and they're less likely to do anything. And because they care about like everything in our kind of world with finances, you're always up for an award for things. And nobody wants to be that lender that does that. Like, so, but see, when you're scraping the bottom of the barrel, that is probably one of my biggest learning lessons as a broker as well, is if you are scraping the barrel, nobody else wants it for a reason. Do I then want to even broker it? Even if I then find a lender that's going to do it, do I really want to do that? Because I worked in that for a year for nothing, and it was so unfair on the client. Like, I couldn't sleep for fucking weeks, like, because I felt guilty, do you know what I mean? Even though I couldn't do anything about it, I felt like it was my responsibility, like, because I was then like, I shouldn't have took him to that lender, but he was desperate for the money. He wanted the money. I thought I was doing the right thing, like, but it did, like, would I now touch something that I couldn't really get touched easily? I think I'm at a stage at that time. I was probably like, I was starting out like of my own company. I was probably more desperate to get deals over the line. Yeah. See now, if I can't get it approved with the first few lenders, it's a bit like this deal isn't for me. So find another and there will be a broker out there that will do it, and there will be a lender out there that will do it. But do I really want to tie my name to that?
Oh no. That was going to be my next question. So, what's your biggest lesson for yourself, either within your business or the lending side of it, with a client or anything?
That was definitely my biggest learn from a client perspective and what I wouldn't take on now. From a business perspective, on my biggest learn is probably people letting me down easily. And everyone that knows me really well will say I give people far too many chances. I think I see the good in everybody, but I think I get walked over quite easily.
Really?
And maybe I've got a wee bit of a tougher skin now because I maybe know my worth a lot more now. But I would say, even with clients and stuff, I feel like I probably had people that would just use me for all my information, but they never actually intended to use me for the deal. They just wanted to end. Right. I think they just knew I was a Do
you think you still get that a wee bit now with a lot of people though?
Yeah,
and
probably.
maybe it's not intentional, but it's just maybe a 10% of a deal, and they're just trying to get all the information?
Sometimes, like, so I had one like really recently, and it was actually one of my close friends' friend that done it, and she was raging, and I was like, no, I was like, it's fine, like, just like these things happen, because I always say take the good with the bad as well, because from that one they might not use me for that deal, but they might cut. I'm
You're great in the network for all that sort of stuff for the conversations.
Definitely, and actually my biggest ever deal with my previous employer came from an £80,000 buy-to-let. And that grew and grew and grew and grew. So I don't turn down the wee deals. I don't shun people away if it's a small, because I think if I help them at the start, or I give them good advice, or I help them through stuff, then they'll come back to me for other stuff. So I'm very much, I'm not small-minded that way. But I would say, me personally, I probably just need to grow. What's that terminology you use? Just grow thicker.
Set of balls.
Grow thicker skin. Thicker skin. That's it. And stop being like, maybe, but maybe that's just me in general. Like, I do care a lot what people think about me, like all these sort of things that maybe with age or experience or life stuff, then I'll not be so much like that maybe one day.
Yeah, good answer. So what's the one rule everyone must follow in bridging? What's the best bit of advice to give when using bridging?
Always know your exit. Like, for sure. Like, if you can't, like, and people say, oh, I'm going to sell it. How realistic is the sales in that area? Like, has other property sat on the market for ages? If there's, definitely don't take a 6-month bridge for sure. Mm-hmm. Like, know your exit and have a plan B as well.
Does anybody ever expect you to kind of know their exit? I know, I mean, it's a daft question, right? But I remember back when I first started using bridging, I used to think, they're not going to give me that lending if my numbers don't work, so surely I'm all right. I remember thinking that, you know, so almost as if you check my end value anyway, so it's fine because you wouldn't lend with me anyway.
Well, we would if we were doing a refurb loan, because the valuer would like comment on what the end value is going to be, but not necessarily for a bridge. So it is just it's on the client's own figures on it. And it all really depends on the spec. So many people say as well, like Vicky's perfect example, she's doing one now, she was going to spend 10 grand on it, I think she's up at 20 grand because, oh, that kitchen, oh, I like that bit better and all that. So so people end up overspending all the time on them. But yeah, I would say knowing your exit, because so many people get a property that's 39,999. They're going to spend 10 grand on it and then they're going to sell it for 60. But actually in that block there's another 5 that are up for sale. So even though they've got it cheap and even though they've spent, are they even going to be able to sell it for that?
Yeah.
So just knowing that your exit is actually a thing.
Secured, yeah. What's your plans in for this 2026 and beyond?
I want to grow for sure. So
grow the team, grow the business.
Definitely. So we obviously run a football club as well, so I've got massive passions in that as well. So obviously get the football club going. We've got our own podcast, so I want to grow that as well. And then, just a business. I would want to take on at least another 4 people by the end of 2026. Brilliant.
So thanks very much, Emma. That was brilliant, superb. Do you want to tell the camera where they can find you? Instagram, websites, anything?
Yeah, so website just rosscommercialfinance.com. We're on Instagram. I think my Instagram's just Emma Ross Commercial Finance. And then we've got Ross Commercial Finance Instagram too. And we've got our TikToks. And I think we might have a YouTube channel as well. Should really know that, but I don't actually. But yeah, on any of our platforms. And LinkedIn as well. Podcast is Business Balls and Banter.
Brilliant. Thanks very much, Emma.
Cheers. Thank you.
So thanks very much for watching, everyone. Episode 24, the Property Coach Network podcast with Emma Ross, talking all things bridging and her business ventures as well. It was really, really interesting. So I hope you took a lot from it. If you can click subscribe, that would mean a lot. And we've got a lot of good guests coming up as well. So thank you.